What's going on, everybody? Welcome to a Capital Hungry Monday Market Analysis webinar. I'll be taking my time going through some fundamental and technical analysis, as well as intraday trade ideas on gold, GBP Jpy, GBP USD, EURUSD, USDCAD, as well as US 30 stock market index. We're going to be looking at fundamentals, market sentiment and investor behavior, as well as economic events and technicals to map out some various trade ideas on these trading instruments just listed. Welcome to the stream. Thank you for your support. If you enjoy these every Monday, as well as the Wednesday live scalping sessions, and of course the Friday self-development live videos, do me a favor and drop a like, subscribe, and share the YouTube channel around. All of your capital hungry resources are listed within the YouTube description. Everything is linked there, and right on your screen as you are looking on the stream reminders little chalkboard animation. Now that we got the nitty-gritty stuff out of the way, let's jump right into it. I'm just going to start off by looking at some key fundamentals that are impacting the overall market and how we can use that information to our advantage, as well as any economic events we have coming up through Asian session, London session in New York tomorrow. And then we're going to go step by step through gold, GJ, GU, EURUSD, USDCAD, and US 30 through that specific order for some intraday trade ideas, lining up some key price points of interest. So, some recent fundamental points. We can see the US dollar as the world reserve currency has been primarily bullish for months now, as the Feds are getting closer and closer to stopping the accommodative support for the economies, as well as giving signals as they were months ago in terms of starting tapering, the tapering amount, how aggressive they're going to be with tapering, and potential future rate hikes. Just last week, we had Jerome Powell give further support to this sentiment as he finally confirmed that inflation is no longer transitory and that the economy does not need to stay in an accommodative state in terms of the support of the central bank, and they don't need to keep purchasing bonds and other assets to support the economy as economic data is rebounding. This led to a stronger US dollar as well as more bearish gold, and I'm still looking to play that sentiment as when we look at the dollar index movement, it's still very bullish, and for the time being, gold is still respecting bearish market structure. We just have to understand that we are early into the new month, and seasonally as well as historically, December is a slower month in terms of volume and volatility for currency markets as you come to the end of the fiscal year and closer to the holiday periods. So that is something you want to keep an eye out on. Okay, something else on the docket was obviously the Omicron new COVID variant. What we have to understand is that the information we got so far of the Omicron variant and the fear associated, the fear, uncertainty, and doubt, has already been priced in by investors. That was obviously the prior weeks when we had short-term strength on the Japanese yen, short-term strength on the volatility index, and we saw global equities have a decline from their highs. But this fear from the Omicron variant isn't enough to shake the overall market optimism, and it isn't enough to cause some long-term strength on our safe haven currencies like the yen, or any long-term impulsive type of downside on the equity markets. When we go to review our market sentiment indicators, such as the dollar index, Japanese yen, volatility index, and global equities, we're going to see that that macro optimistic sentiment is still holding, and we're going to be potentially looking to take advantage of that information when we dissect and narrow down into our currency pairs, okay? So far, the fear that and information we've had from the Omicron variant has already been priced in. Unless we get new information regarding the Omicron variant, such as major countries going into lockdown, or over the next period of weeks that current vaccines are ineffective for this new variant of COVID, other than that, there isn't really anything else on the docket regarding Omicron variant news that already hasn't been priced in by investors in smart money and already digested by the markets. We already know the new variant exists. We already know we're getting a slow spread in various countries where you're finding the 1 or 2 off cases. We are unsure about the resistance to vaccine so far. And so far we've had countries promote some travel restrictions, but nothing in terms of large lockdowns or anything that can leave economies stagnant again and impact economic activity. So when we look at our market sentiment indicators, it's going to be very easy to identify that our global stock markets are still bullish, as well as the Japanese yen is bearish, volatility index bearish. It's only the US dollar that's still bullish, but that's due to the fundamental reason already stated about the dollar primarily following the central bank policy positioning of the Feds. Now, when we look at our market sentiment indicators here, the Japanese yen, dollar, and volatility index hand in hand, I still want to play the dollar strength sentiment when I'm looking at GBP USD and EURUSD for GU cells, EURUSD cells, as well as I'm still in a USDCAD buyer bias, right? We can see on the dollar over the last period of months, we've been in this very strong bullish market structure. And as we've had new highs printed by buyers, we had a short-term pullback phase, but a short-term pullback phase to a demand zone with an order block and support created where we're still trending bullish to potentially revisit these previous highs. And when you look at the overall movement of the dollar, as investors have been pricing in the potential more aggressive tapering to come, as well as future rate hikes and stronger US economic data, because as we analyzed in previous webinars, US economic data is back to pre-pandemic levels. The US has not been dealing with a lockdown, and unless the US goes into a lockdown, they can keep talking about COVID as much as they want on the news and bringing fear to push vaccines, but there's really nothing to impact economic activity on the macro scale. We're seeing labor market figures back to pre-pandemic levels, retail sales, PMI figures, industrial sector, manufacturing sector, and so forth. So as we've had that progression in economic data and the Fed start to give us the signals of when they were going to start of potential tapering rumors in the June-July period, then when they were going to start tapering August-September, then the actual tapering start October, November, and so far we've seen very nice bullish market structure with buyers continuously printing highs and only having pullbacks to the upside. And as the US dollar is the world reserve currency, you can see that this structure is correlated when you see the inverse on GU, EURUSD, and a positive correlation in terms of USDCAD. So I am still in the bullish bias on dollar and looking to play the dollar bulls accordingly in those correlated currency pairs like GU, EURUSD, and USDCAD. On the Japanese yen though, the Japanese yen has been primarily following its properties as a safe haven currency on a global scale. So as the global demand of investors has been in the equity markets and other assets like real estate, commodities like oil and so forth, there's been relatively low demand in the Japanese yen as a safe haven currency. So on the higher time frames, it's been in this overall bearish market structure with sellers continuously printing lows and only having pullback phases that are sellers taking profit and liquidating positions out of the market, pushing us up with buyers jumping in to push us up to more favorable supply zones, and then collecting more sell orders to drive down into lower lows, right? We can see with the overall structure here on the intraday time frames on the Japanese yen, after this low was printed here, we had some profit taking by the sellers, a pullback phase to this lower high point here, where we had more sell orders flood the market and a lower high print, and a lower low printed here, right? So what that is telling me is based on price points of interest, bearish market structure is being validated below this price point. What's very interesting is as we had this low printed pullback, more sell orders flood the market, leading us into lower lows. We can see from these lower lows, the pullback that came with the Omicron variant fear still came to the specific price point and rejected. And now we are still rejecting that area with the potential that if markets stay relatively optimistic, for example, the volatility index stays flat and comes back below 27 and equities continue hot, that the Japanese yen can have some pullbacks, but primarily we're looking to play that bearish structure of it continuing to revisit previous lows, right? Low printed, pullback, drives down to the previous low and lower low. Same thing here, low printed, pullback, drives down to the previous low and lower low. Low printed, pullback, drives down to the previous low and lower low. Low printed, pullback. You guys are getting the idea of how market structure works, whether it's on the bullish side or bearish side. Also, obviously with that bearish Japanese yen sentiment, we will be looking to use that to our advantage when we're starting to narrow down on GJ. When I'm looking at the dollar, when I'm looking at the Japanese yen, and when I'm looking at the volatility index in terms of US equities guidance, for me to switch out of a bullish bias on the dollar technically, we would need to break below 95.5, and then I can see GU and EURUSD doing deeper pullbacks from their low points, which we'll look at in a second, and also USDCAD having a deeper pullback from its intraday highs. And for me to be in a Japanese yen bullish bias, I would need to see buyers break above that significant lower high price point that led into these lows for me to see further GJ sells. Because the same time the Japanese yen printed this low and is coming up to this lower high point and rejecting with more potential sell orders entering the market, we're also going to look at GJ, which has come down to a daily demand zone that hasn't broken for months. And we'll look at that in a second. Also, to further confirm that the fear from the Omicron variant has been priced in, when we're looking at our Euro, UK, and USA equities here, US 30, FTSE 100, and the German DAX, we can see that with the market fear that came from the Omicron variant, as well as the start of the new month of December, we had this downside move that was relevant across the regions and across the board here. Same thing with Asia Pac when you're looking at Australian equities ASX 200 here. But what you have to understand when we look at US 30 chart individually is that these pullbacks from that catalyst still came from all-time highs or previous highs being printed by buyers, and it came down to a previous low or demand zone and is still failing to break, maintaining the overall bullish market structure integrity, right? So you can see the example with the global equities, but when you come here and look at US 30, it's not out of the normal that we haven't seen these types of pullbacks from highs being printed before. As buyers liquidate positions, sellers jump in hand to push us down to more favorable demand areas. But overall, stock market buyers have been extremely optimistic, riding that support of the central banks, which is still evident as interest rates have not been hiked across the board yet, especially for US rates. Yes, we're starting to get some potential signals, but no confirms yet. So when you're looking at the overall structure, we can see US 30 came to this demand zone, failed to break, and we're getting a very aggressive bounce on it. The same time we're seeing that Japanese yen weakness, we can see GJ came to this demand zone that hasn't broken since the start of 2021, and this pullback to this demand zone still came from a new higher high being printed, right? So we're at very specific price points of interest when we're looking at GJ, US 30, and our other trading instruments, and I am looking to play that potential rejection on the volatility index and bounce on equities, and a lot of the Omicron fear being priced in, the potential rejection on Japanese yen here, and bearish potential movement on yen, bearish sentiment on VIX, and bullish sentiment on the dollar, okay? Now, the only way I would see Japanese yen strength come back into the table, or dollar bears, or VIX break above the 32 handle is if we get more market fear over the next period of days or sessions regarding Omicron variant that we haven't already had yet. We need new information that hasn't been priced in by investors yet. So you might be asking, Jeevan, what is that information? Well, we would need to confirm that the current vaccines are ineffective for this new Omicron variant. That would mean that this potential new variant is higher risk, and that may lead into countries going into lockdown again and so forth. Or if we have various countries confirm that they are going into lockdown because there's a surge of cases or more travel restrictions or whatever it may be. Unless we get those confirms, everything so far regarding the Omicron variant has been priced in. Okay? The only way Japanese yen is breaking above this lower high price point and continuing more bullish, the only way the volatility index is breaking above 32, and the only way dollar is breaking below 95.5 and 95 is if we confirm that that current vaccines are ineffective for this new Omicron variant, a further surge in cases globally, and countries going into lockdown or imposing some types of lockdown restrictions that will have a direct impact on economic activity. Does that make sense? That is the potential new information, new news that we need to receive that would bring the fear sentiment back. Otherwise, the fear moves have been priced in. This was the pricing in here on the Japanese yen, the fear move. It spiked up on the market fear, but still wasn't enough to break that lower high price point. This was the fear move here on the dollar, which caused a spike down to this demand zone. And this was the fear spike here on the volatility index. But you can see, even with those fear moves from the Omicron variant and the downside moves we saw in equities, we still didn't break the bearish market structure on yen overall. We still didn't break the overall bullish structure on the dollar. We've seen pullbacks and upside moves before. We've seen pullbacks and downside moves before, and we still didn't break the overall bearish market structure when you're zooming out and looking at the volatility index. And clearly global equities are still bullish when you're looking at the Eurozone, when you're looking at the US, and when you're looking at UK equities, and just more individually on the US 30 here. Okay, so now that we got that fundamental information out of the way, macro sentiment information, let's just quickly look over what economic events we have overnight and today and tomorrow as well, and then we'll jump into our actual technical analysis and trade ideas, bringing all that information together and mapping out some trade ideas on gold, GJ, GU, EURUSD, UCAD, and so forth. Somebody says dollar will need to pull back. Who says that? Why? Is it too high for you? Fucking hell, man. Some of you guys are retarded. So the date is November 6th. We do have Reserve Bank of Australia's cash rate. So that is going to tell us more about global central bank policy positioning with their statement. But more importantly, we're looking at this chunk of data here for overnight and for the New York session tomorrow. So at 2 a.m. Eastern, we have the Halifax house prices for more UK economic data. Also at 2 a.m. Eastern, pre-London hours, Germany's industrial output. This is going to be dog shit. This is a high probability the German data and the German economic sentiment data is going to be very bad. Okay, 2:45 a.m. Eastern, France's reserve assets, which is obviously going to impact Eurozone. 5 a.m. Eastern, Eurozone's overall GDP for the yearly and quarterly revised. Also at 5 a.m. Eastern, Germany's ZEW economic sentiment and current conditions. At 7, we have milk auctions for New Zealand, and then at 8:30 a.m. Eastern, international trade balance figures for the US. Also at 8:30, medium-term reports, labor costs and productivity reports. At 8:30 for Canada, trade balance report. 10 a.m. Eastern, the Canada IV PMI figures. And then later in the afternoon, consumer credit information for the US. And at Asian session, Japan's GDP figures for the quarterly revisions. Okay, now let's take a look at gold here. So you can see ever since Joe Biden selected Jerome Powell to be the Federal Reserve head again, which led to this impulsive move here and lows being printed, then you can see we had this pullback by sellers and more sell orders collected here that led to lower lows. This move, impulsive downside move on gold here, was when Jerome Powell said that inflation is now a risk. We need to start combating the inflation. So when the Federal Reserve gives hints that they're going to start more aggressive tapering, as well as potential future rate hikes, and look to use their monetary policy tools to combat the very high inflation, as they no longer see it as transitory. This is all bearish fundamental factors for gold. We can see that the historical repetition is also still very relevant compared to the 2008 period, where we had the highs peaked by buyers during the low interest rate phase. Very strong supply zone that fails to break, start to create some bearish market structure as the Feds look to be more aggressive with their tapering of stimulus support post-economic crisis, and also look at interest rate hikes. You can see we make our way down to that demand zone and potentially see gold enter some corrective structure. So as the Feds are giving more signals towards aggressive tapering, potential future rate hikes, and combating the ever increasing inflation from printing out 40% of all US dollars, I've been playing the bearish bias here accordingly on gold, fundamentally and technically, okay? So when we're zooming in more, what we can see is still stronger impulsive moves by the sellers. Sellers still continuously printing lower lows and only having these short-term pullback phases that go to collect more sell orders before overall continuing down. As long as we don't have any new market fear and we still have the US dollar holding its strength and that sentiment holding, and obviously the Fed sentiment still holding that weight and continuing rebounding US economic data, my anticipation is still looking for pullbacks to retest these price sensitivity areas and making our way back to the downside. So the white lines are historical higher time frame key levels. When I'm looking at the market structure, you can see from this point here, we had lows printed by sellers, and these same lows maintained for almost a period of a week when you're looking at where the actual candle bodies were closing, right? But from these lows, you had profit taking by sellers and a pullback to this specific price point of interest here, where we collected more sell orders in the market, driving us down into these lower lows here, right? Then from this low being printed, you can see we had another pullback move as we had lower lows printed by sellers. Sellers take profit and exit out of the market. Buyers jump in to create that pullback phase, where we then had more sell orders collected from 1789 price point 1790s before having another impulsive move to lower lows printed here. Bearish market structure, in my opinion, is still very valid below the 1789 price point on the intraday time frames. Okay, so I will be looking for potential retests at those areas and still sells down to revisit these lows as target points, following that fundamental bearish impacting factor of Jerome Powell saying inflation is no longer transitory, potential signals at future 2022 rate hikes, giving signals at more aggressive tapering, and the bearish market structure with sellers still on the intraday time frames continuously printing lower lows, or at least driving down to the previous lows as target points. So this is what I'm looking at on gold here. Is if we get a retest at 1789, still looking for sells to target these lows, breaks below 1772 sells, with the safest sells below the previous lows at 1764s. That's your most confirms but least reward. High risk, high reward, less risk, low reward, as you're looking for an anticipation of the break below the previous lows continuation move. Okay, I would only look for buys and the red box being the sell areas. Okay, I would only look for buys on gold in the short term if we broke above 1795, and that would still be looking to set up better risk versus reward sells at the 1800s, 1803 price points to the left there. Okay, as long as we don't have any new market fear and we remain below 1812s on the intraday time frames, I'm still primarily bearish. Obviously, you can see that gold does these intraday pullbacks, but the overall structure is still having these pullbacks that just go to collect more sell orders and making your way down. So once you can identify that pullback and you can get the confirms of exhaustion and sellers jumping back into the market with like the resistance here, the rejection and snapback here and so forth, then you have really nice clean confirms to start driving and targeting the previous lows as long as the current fundamental sentiment holds. Okay, the only way I see gold shifting into a bullish bias on the intraday time frames is that we would need to break above the bearish market structure and come above 1803s, because you still had way too many sell orders collected in these two price points that led to impulsive moves and lower lows being printed. And you can see that any aggressive pullback phase does not fade out the seller's impulsive moves and continuous lows being printed, right? The only thing we have to watch out for is obviously the volume and volatility as we're coming towards the holiday season, end of the fiscal year, and so forth. Okay, so those are the trade ideas on gold. You can always rewind and check out exactly what I was talking about there. GBP JPY. So on GBP JPY, ever since here, we've been playing a bearish bias in sentiment, which has been shared for free and within the private channel, whether it's through the market update webinars or the live trading streams on Wednesdays. Basically here, once we had highs printed by buyers, we had the Bank of England at their last interest rate decision throw a curveball and go against expectations of rate hikes. For those of you who don't know, one of the reasons we had such a strong bullish move off this demand zone here that led into new highs being printed was that Bank of England gave rumors before their interest rate decision a couple of weeks prior that they were going to look to raise interest rates because the economy was having a strong recovery, right? Then, so obviously buy the rumor, sell the news. Just with the rumors of the Bank of England potentially looking to hike interest rates, investors already started to price in that bullish fundamental factor on GBP, and you saw buy orders flood the British pound against the yen until we peaked these higher highs. Then this over here, this impulsive move here, that was the actual Bank of England interest rate statement day and announcement. At the actual Bank of England rate decision, they threw a curveball of what they gave signals and rumored at before and did not hike interest rates. So we had a correction of that move, a pullback, and then this impulsive move that we also took advantage of was the Omicron variant being introduced a couple of weeks ago, right? When the Omicron COVID variant got introduced, this led to an outflow of equity and liquidity within our risk currencies, for example, GBP, Euro, NZD, AUD, and so forth against the Japanese yen, and led to an inflow of liquidity in the Japanese yen as a safe haven currency, right? So during the times of fear, uncertainty, and doubt, which obviously was associated to this new variant of COVID being discovered, we saw global equities take a drop. We saw the Japanese yen pick up strength as a safe haven currency, and we saw an outflow of liquidity within our basket of risk currencies, right? But now as the COVID fear regarding this Omicron variant has been priced in, you can see we're back to this very, very strong demand zone that hasn't broken since the start of 2021. The same time we're starting to get some exhaustion by sellers at this area as well, which we're going to zoom in to understand here. So what's very interesting, I want you guys to look at this correlation. The same time GBP JPY is coming to this demand zone that we haven't broken in months and potentially having a bounce from here, is the same time the Japanese yen is also coming to that significant lower high price point that led into these lower lows in rejecting and still maintaining its overall bearish market structure. And it's also the same time we're seeing that bounce on GJ at this demand zone is the same time we're seeing a bounce in UK equities as well. So do you see how the fundamentals in market sentiment and technicals work hand in hand? It helps you paint a more clear picture of what's going on, of the overall money movement through the markets as a whole. The market sentiment in combination with the fundamentals, in combination with the technicals, right? So as long as GJ holds above this price point, I am in a bullish bias. As long as GJ holds above 149, as long as UK equities hold above 7,000 flat here on the FTSE 100, still maintaining its overall bullish structure, and as long as Japanese yen does not break above 88.9, 89 area, then I am in a bullish bias on GBP JPY, potentially anticipating a bounce from here, okay? What we can also see is getting some exhaustion from these lows and a very strong bounce from that demand zone here, okay? So, but now, even though we're potentially starting to see buyers jump back into the market again, where we don't have our neck out of the woods just yet, based on the intraday market structure, you can see that we're still bearish and we still have sellers continuously printing lower lows. From this previous low that was printed here, we had sellers take profit, create a pullback phase that came to this supply zone, and then from this supply zone here is the last price sensitivity area at 150.8, where we had sell orders flood the market and lead into lower lows, okay? So really, to see safe buys and validate a break of the bearish market structure, you would need a break above this price point. The trend line is nothing, okay? Get rid of all this shit. The trend lines, the support lines, the PPLs, that's just to help us with visual representation of market structure and trends. What's really important is price points of interest, right? So when you're looking at the structure, you can see that from that area, we've had sellers continuously driving price down as we've had the market fear with Omicron. We had the Bank of England throw that curveball until we came to this very specific demand zone. But again, we had sellers come and print these lows. A pullback phase to this area that led to this supply zone here. More sell orders being collected and an impulsive move into lower lows. Bearish market structure is not technically broken, and we cannot confirm more buyers in the market unless you break above here. Okay? Then we can confirm more buys to start looking to revisit these price sensitivity areas of interest. A trend line is just a visual representation that you can use to help you see a trend or structure easier, right? But trend lines are very subjective. Price points aren't subjective. Price points are objective. There's nothing you can say against that we had a drop from, you can't say anything that we had a drop from 150.8. That's exactly where it happened from. But you could draw a trend line here. You could draw a trend line here. I could draw another bearish trend line here. I could draw another bearish trend line here. That can never end. Do you understand what I'm saying? Trend lines are subjective. Support and resistance are subjective. But price points of interest, that doesn't lie. Wicks don't lie. Numbers don't lie. Prices don't lie. All right? So this price sensitivity area here, just like over here, for example, look, you had a low printed by sellers, profit taking, a pullback area to here, and then more sell orders enter the market here that led us into these lower lows. You can see you had a pullback almost up to that exact same zone where it looks like you're going to be potentially breaking the bearish market structure, but you still don't break that price point of interest and you drive into lower lows. Okay? So that is something we have to be very cautious about. So, but when I'm looking at GJ, these are the trade ideas I see in the short term. that 149 is a very, very strong demand zone. If we break below 150.2, I still see short-term sells down to this demand zone again, and then potentially buys with a double bottom at that demand zone that hasn't broken in months, okay? Or I see break and retest buys above 150.8, scaling above accordingly there. And then scaling up, obviously, above 150, 1.2, and so forth. Okay? So if we still reject and don't break above this price point, then come below these candle bodies here, then we're still going to continue to play this structure and take the sells from below those low points, 150.2, down to these lows as a target point. But I'm still looking here for a high risk, high reward buy area because this demand zone has not broken in months. Okay? This demand zone institutionally, no matter how aggressive sellers moves you had down to here, no matter how strong the market fear looked, this demand zone has not broken in months still. Okay? Next, GBP USD and EURUSD are going to be very similar. Remember, on GBP USD, it's a completely different beast compared to GBP JPY, primarily because it involves the US dollar, which is the world reserve currency. So as GBP USD has been more of this bearish market structure, right? You can see it's been the inverse of the overall dollar movement here. Dollar has been extremely bullish. GBP USD, Euro USD has been bearish. UCAD is a primary correlation, a positive correlation with the dollar index, right? It's been more bullish. So on GBP USD, on the higher time frames and intraday time frames, we can see that sellers are still continuously printing lower lows, and the price action is still very bearish. We still had the day before this previous daily candle closed with a bearish engulfing, and the previous daily candle closed almost half the body size. So even if we get pullbacks to these price sensitivity areas of interest, I would still be in a bearish bias on GBP USD, looking to target these previous lows and lower lows, right? So the higher time frames on GBP USD are bearish, the fundamentals on GBP USD are bearish, and the intraday price action and market structure is still bearish here. So remember, the trend line, these historical key levels and trend lines, of course, very good as market structure indicator points, retest points, and so forth. But remember, when you're looking at this market structure here, you can see that this price sensitivity area is the last price sensitivity area where we had some lows printed by sellers, a pullback phase to this area, and then driving down into lower lows, okay? So we're still maintaining the bearish market structure integrity below those price points of interest, regardless of this, even if we break above the trend line here, right? So these are the trade ideas I see in the short term on GBP USD, okay? Just as we have another significant low being printed and some short-term exhaustion on the dollar, if we break above 1.327, I can see some short-term pullback buys to retest better risk versus reward sell areas to continue us right back down to the lows and potentially lower. Or just safer sells below this medium-term zone in 1.321. So this is the short-term pullback buy option above 1.327, but I would still be looking here and here for sells and then driving back down sells. Or if we don't break back above 327, we break below 1.323 and break below 1.321. I don't like to counter trend trade. I primarily like to play with the market structure and current fundamental bias. Keep in mind some of that economic data we have overnight as well. Okay. Euro USD, similar idea on the daily chart here. Very bearish. We had a low printed by sellers. We had a pullback phase, collect more sell orders. With the potential, if dollar holds its strength, we have a target point of these previous lows, right? Very similar to any other situation. Low printed by sellers, pullback phase, you can at least target the previous lows. Lows printed by sellers, pullback phase, you can at least target the previous lows. So no point fighting the trend, no point trying to guess a bottom, no point trying to fight the current strength in the dollar here, right? You can see dollar had its pullback phase. It's still holding its intraday bullish market structure here. Okay. So on Euro USD, just more adapting to the intraday time frames and the market structure. I was just looking at some of this pullback structure for a break below it. We can see the volume and volatility is very weak, but I'm still in the sell bias. So on the intraday time frames, look, we had a low printed by sellers here, profit taking by the sellers, buyers jumping in hand to create a pullback phase. More sell orders flood the market here that led us into lower lows. Even when we had the short-term weakness and pullback on the dollar, you can see that pullback came exactly to that same price point of interest before collecting more sell orders and having these downside moves. Nothing in the market is random. Everything is pre-planned, precise, surgical. There's precision with everything, every movement in the market, right? Regardless of the time frames as you zoom in and really start to gain your experience and understanding, right? So really on the intraday time frames, bearish market structure, regardless if you draw a trend line here and say, oh, this is the bearish structure, we're breaking the trend line. No. Bearish market structure is respected from a technical standpoint as long as we stay below this price point on the intraday time frames. Even if you get a pullback here again, you can see more sell orders getting collected and still coming down into lower lows. And when you look at the movement of Euro USD, look, it's not out of the ordinary to potentially look like you're breaking structure. Like, let me give you a prime example. If you just went based on a trend line, you do this and say, oh, look, it's buy time now, right? But really, you have to look at the market structure and the price sensitivity areas. And this is the last price sensitivity area here that led into the lower lows. You can see you even have some fake outs here where it looks like it's going to break a bit higher, but you still in general stay below the previous low in this price sensitivity area, and you retest this area multiple times on the intraday time frames before still driving down, right? So you can't just look at the trend lines, you have to look at the overall structure. When I'm looking at Euro USD, I'm still looking for pullbacks to 1.3100 cells, breaks below 1.27 cells, breaks below 1.25 cells to revisit these previous lows as a range target point. Remember, regardless if you're moving bullish or if you're moving bearish, the market moves up in two fashions. If you have a bullish trend, you're going to have buyers enter the market and buyer order flow flood the market. This is going to extend to a specific price point of interest that they have predetermined, the market makers, the whales, the institutions, that they want to potentially look to liquidate some positions and potentially look to create a demand zone to come to also add in more positions. So you have buyers enter the market, extend up to a high price point of interest. Then as they liquidate positions, for them to exit the market, you have to have an order collected on the opposite end. Sellers jump hand in hand and make their money. You have price then do a pullback technically to a demand zone where buyers scale in more positions to at least target the previous high and continue higher, which we observe as bullish technical market structure. Or you have a consolidation phase at a high which looks like that can fake some technical only traders out as a resistance, but this is order collection to have enough volume and order flow to continue higher. This is the combination of pullbacks or consolidation zone and continuations to the upside that overall prints bullish market structure as you watch the trending market. That is the transactions between buyers and sellers, or the order flow collection that happens. When you can identify market structure and understand the transactions between buyers and sellers behind the scenes from that price point, from that standpoint, and align it through reading the technicals, it's so easy to read market structure. Same thing if you have an asset class going down. You have an impulsive move to the downside, a pullback, more sell orders collected, sometimes a consolidation at the previous low, a pullback that can come all the way down to that supply zone again. But it's a combination of the pullbacks, consolidation zones, and overall lower low still being printed that creates the bearish market structure. You can go onto any stock market index, any stock, any freaking asset class, commodity, oil, and gold, doesn't matter, and you will be able to break it down with that simple concept. Okay? But anyways, EURUSD, looking for still pullback sells, break below 1.27 sells, breaks below 1.25. I'm expecting the industrial data from Germany to be terrible. And look at UCAD. It's the exact inverse of what I was just telling you guys. When you're looking at the overall market structure of this asset class from the start of November to current period, you can see its overall bullish market structure. Buyers continuously printing higher highs, having pullback phases as they liquidate positions and coming down to more favorable demand zones and creating lower highs or revisiting the previous lows and still continuing up to the upside, right? So no point fighting this trend. We are starting to get a little bit of exhaustion from these highs, but it's just a consolidation phase for the time being. I'm still looking for buys in these potential areas of interest, and primarily looking to play the bullish bias. I know the Canadian dollar starting to pick up some short-term strength with crude oil turning back bullish again after having that aggressive dip, but we can still have that US dollar dominance. We still have this bullish market structure and technical bullish price action when we're looking at USDCAD. Okay, last but not least, US equities, US 30, we can see same thing. When you're looking at US equities from this crash low point, the market structure is a combination of exactly what I'm telling you. Overall, bullish market structure, you're just having these consolidation zones that collect further liquidity, buyers printing higher highs, still maintaining the overall bullish market structure integrity from this demand zone here. And we have so far the market fear being faded out of the Omicron variant. Very nice bullish price action with this bearish candle at that demand zone being engulfed. Weaker bearish candle here that closed with the weaker body grabbing liquidity. Another bullish engulfing breaking above these candle bodies with some stronger intraday bullish market structure developing as well. On US 30, I'm looking for buys from 35K, 34,600, and above 35,350. Okay? So, all right, everybody, thanks for watching. We went through the current fundamentals impacting gold, GJ, GU, EURUSD, USDCAD, US 30, global equities. We went through the fundamentals, market sentiment, looking at the market sentiment and understanding the movement, individual movement of the dollar, Japanese yen, VIX, and equities. We went through the economic events we have on the table, some higher time frame analysis, intraday analysis, and those are the trade ideas I see across the board on those various trading instruments. Remember, I am not a fortune teller. I am not a magician. Remember to do your own due diligence and analysis. Follow your trading plan. follow your risk management plan, and trade smart. If you want daily market updates like this, as well as daily New York scalping sessions, access to a minute-by-minute newsroom, weekly webinars, 50 plus educational webinars, access to a community of like-minded traders, then come join the private channel where I do these types of webinars every single day at Asian session at the end of the day. We also do a New York scalping session 5 days a week every morning, weekly recap webinar every Sunday, market update webinars, higher time frame review webinars, and we break down other pairs. The channel also has key level price alerts, session reminders, psychological reminders, news alerts. Too much shit for me to list out right now. But anyways, make sure you check out all your resources in the YouTube description. If you enjoy these streams, like and subscribe, and I'll see you guys on Wednesday for the New York scalping session.